Hey guys, it's Conrad Bobulak here, CEO of Investors Prime Real Estate and best-selling international author of Australian Real Estate Investing Made Simple. Welcome to today's video. It is a bit of a dry topic, interest rates. Not the most exciting topic, but probably a topic that has more impact directly on property investing than any other factor, apart from location, obviously, and quality of the asset. But interest rates have definitely been the determining factor in the last 5 years and have been responsible for determining where we are in the property cycle, and also navigating through supply and demand have been very influential in dictating what the markets are doing. Interest rates probably are the most significant aspects of property investing because cash flow is king. And I'm going to do a video just about cash flow and talk about different aspects of cash flow versus gearing versus things like formulas the banks use to assess your sort of stability right down to credit scoring. But today is going to be a bit dry, but it's a very important topic because I'm going to share with you what the experts and the banks believe will happen in the next 12 months in the interest rate arena, where interest rates are heading, and what are the implications of these to property investors like yourselves. So sit back and relax, grab a coffee or a V drink, and enjoy today's video. Bit of a disclaimer, by the way, I'm not here to give you any financial advice. This is only purely for educational purposes only. So before you do anything, speak to a qualified mortgage broker or a banker or a financial planner. Make sure that they do have the exact results that you want to achieve before you get advice from them. Bit about myself. I've got a diploma in financial services, financial planning, mortgage broking, real estate. But the most important thing, guys, is I'm a property investor in Melbourne with a multi-million-dollar property portfolio that I've built up over the years. And everything that I'm teaching you on this channel, I'm using myself and my clients are implementing as well. So I'm keeping it real. By the way, I want to thank you guys for supporting me and buying my book. It's gone multiple times now, #1 bestseller on various platforms. Soon to be on Books Buy as well, which is a new platform that's kind of competing with Amazon. But yeah, I want to thank you for getting to #1 multiple times on various categories in Amazon, which is kind of the biggest platform now for books. So if you want to get a copy of Real Estate Investing Made Simple, jump onto realestateMadeSimple.com.au, or if you want to learn how to smash your mortgage in record time and fast track your wealth creation through property investing and how to use trust to virtually have unlimited borrowing potential, get a copy of Australian Property Finance Made Simple. I'm about to upgrade that book as well because it is about 10 years old now, but fundamentally nothing's changed. There's a bit of background legislation that have changed. A few loans have disappeared, a few new ones have come onto the market, a few lenders have gone, a few lenders have merged. But really, fundamentally, nothing's changed, guys. It's still, this book is as current as it is 15 years ago. Interest rates in the book for all my examples are 5%. And, we've been hovering between kind of 3.5% and 7%. So it's kind of very, very accurate in terms of how people structure their property portfolios. So if you want to get a copy, bookonfinance.com.au. Now let's get into it. So the four major banks now are competing for their market share of clients. And, ANZ's got the biggest bank book in Australia. So they're all kind of jumping in now and cutting rates in light of what's happening with the RBA. The RBA has been very vocal about their job to curtail inflation. Inflation was unacceptably high. Now it's come down to between 2% and 3%, which is exactly where the RBA wants it to be. Employment's full. GDP per capita is at a recession level. So, Labor has kind of destroyed the economy to a large extent, which means that there is no pressure on inflation because people don't have money to spend. People are struggling just to put food on the table and struggling with everyday bills. So really, for investors, this is really good news because in an environment where inflation is low, there's a very good likelihood we're going to see multiple rate cuts on the horizon, not just one or two, but, something like 10 or 15. So the housing market has completely been reactive to a large extent on the back of any announcements around interest rate cuts. We've seen that time and time again. People make decisions largely when it comes to their owner-occupied properties based on where interest rates are heading and how much money they have left over each month after paying their mortgage. So it's a huge part of the housing market. And if you look at the projections, and by the way, just so you know, when you see projections from the banks, do take them with a grain of salt because every week they'll change their mind slightly. 1 week CBA comes out, there's going to be 4 rate cuts, and we're going to hit the bottom at 3.1% in mid-26. Now there's 6, now there's 7. So they do change their mind from week to week, or whatever color tie they're wearing on the day. But hey, that's all we got to go by. So CBA has predicted 4 rate cuts in 25, from with the end of 25 finishing off at 3.35 bank swap rate, which means the variable rates will be around 1.5% higher than that, which is around 4.85, let's say. And then mid-26 is predominantly where everyone's kind of agreed will be the bottom of the market, which is interesting. 3.1% for the bank swap rate. So you're looking at variable rates at 4.6. Westpac, 4 rate cuts, forecasted for 25. And it's pretty much the same as CBA, ending 25 with 3.35, and then hitting the lowest point in 26, June, July at 3.25 bank swap rate. NAB, 4 rate cuts, similar story, 3.35 end of 25, 3.1 mid 26. And ANZ, always more conservative than the others. They always like to be conservative and come in a little bit better. So undercommit, oversupply, I guess, or over-deliver. 3 rate cuts, 3.85, that's so conservative, and 3.6 in end or mid of 26. Now, what does this mean for the average $600,000 mortgage? Now, I don't know what kind of mortgage you have in Melbourne, but $600,000 won't get you far. But I guess across all of Australia, this is kind of where we're at. I know most people in Melbourne have $1 million mortgage if they're getting into a property in an established suburb. Maybe if you're getting in a fringe suburb, you can have 600, 700, 800,000. But it means that really, in terms of an owner-occupied property, $600,000 mortgage over 25 years at 6%, you're paying $3,866 per month. A rate cut of 1.5%, which I think is where the bank is heading, is a monthly saving of $500. So your repayments will go down from $3,866 per month to $3,364. I apologize, I've got a dry cough. I've just had a bit of a flu, and I'm still recovering, I should say. I'm not retiring. I will retire eventually, but not now. So the 4 major banks have made many predictions, as I mentioned, and literally like every week those predictions will change. But the good thing is they're all in the same direction. They're all telling us this is the trajectory. There's no conflict between these opinions of all the lenders, including the 4 major banks. I'm only using the 4 major banks because they have majority of the loan book in Australia, over 85%. The rest is kind of scattered throughout other lenders. So ANZ, 25 basis points and a 25 basis points by February. CBA 25 basis points by August, September, and then hitting a rate of 3.35 by end of the year. NAB 25 basis points cut in July, and also the cash rate will be 3.35 by the end of the year. And Westpac 25 basis points in August, November, taking the cash rate to 3.35 by the end of the year, which means that the variable rate will be 4.85. Now, if you're getting rental yield returns in Melbourne in good areas of 4.5%, 4.75%, literally with an additional 1% in expenses, with negative gearing, the cash flow neutral or positive, which is fantastic. So when you're doing rough numbers, by the way, on the investment properties, let's say your cost of funding is 4.5%, always add 1% on top in expenses, which is council rates, land tax, building insurance, property management fees, landlord's insurance, all those kind of things. So the cost is 5.5, and then obviously you have tax deductions. If it's in an individual name, if it's in a trust, you get to quarantine the losses, and then they keep accumulating until the trust starts distributing cash flow positive income to the beneficiaries. Now, here's an interesting thing. There's major lenders that have cut rates. They're all cutting rates individually. Some are more aggressively than the banks because a lot of the lenders are competing with banks. What I mean by lenders, I'm talking about Macquarie, Liberty Financial, Pepper Home Loans. They're trying to get their slice of the action as well, and they are competing on the rates to a lot of extent. They are also competing on the unique features. A lot of them do subprime lending, which is non-conforming lending. So subprime in America, obviously, but in Australia it's non-conforming. So people that are credit impaired, insolvent, or have bad credit files. But analysts believe that there's going to be definitely a really good rate cut. And on the back of that, you're going to see an increase in the housing market. The main argues that house prices could jump by 12% in the next 2 years if the official cash rate is cut by 1.5 from its peak to of 4.35 bank swap rate. Now, that's a very important thing because that means that by the end of mid next year, there could be a potentially 12% increase in house prices. In Melbourne, that means that the median price will go from 1,035,887, which is what it is now. That was March 25 to 1.16 million. But there's other suburbs that will go faster, others will go slower, and some won't be affected at all. But that's an interesting thing. The mains analysis is based on the Chillip model, which is based on Peter Chillip from the Centre of Independent Studies, which forecasts that for every 1% cut in the cash rate, prices rise 6% in the first year and 8% in the second year, because it has to sink into the market, and then future growth prices influence other prices in the future. And there's spillover effects with suburbs as well, which what it means is if for example, Brighton goes up, then Brighton East goes up, and then Brighton East goes up, Bentley goes up, and if Bentley goes up, Bentley East goes up, and if Bentley East goes up, Moorabbin gets dragged up. So every suburb has a spillover effect of suburbs surrounding it, which is quite interesting. So Melbourne's going to go up by 150 grand in the next year or two, which is cool. Some suburbs will do better, some will do worse. Our auction clearance rates are 76.6% as of for last week in June, which is a very healthy market. That means 7.6 houses out of 10 are selling at auction. And we do a lot of auctions in Melbourne. Behind Sydney, we're pretty much one of the most dominant markets. I mean, last week we had 1,018 auctions in Melbourne compared to 829 in Sydney. So we are the main market for auctions. But I'll do a whole YouTube channel video just on auctions and why people do auctions, because auctions never get you the best rate, the best sale price. They give you the second best sale price. And I'll talk about what that means in another video. But it is a healthy market. The market's definitely hit the bottom and has bounced and recovered. And this is reflected in CoreLogic, daily index on the 28-day rolling index. You can see there's many indicators now showing that we have recovered from the peak. And each trade cuts are, nearly 90% certain that they're going to happen. So we have a lot of confidence that this is going to happen. And GDP is down, which is pretty good as well, because if GDP is up, then there's inflationary pressures. So we're in a technical recession in Australia per capita. In terms of productivity, people are doing it tough, businesses are going down. But for property investors, which is the main focus on this channel, that's good news, because that means you can keep cutting rates in an environment where there's no chance of inflation going up. Because if the economy is bubbling and doing really well, then inflation can go up, and which means the RBA will stop cutting rates. But if the economy is doing badly, which is what it is now, and businesses are still failing and going under, for property investors, which is not a good thing, by the way, but for property investors, that is a positive thing, because that means that RBA can keep cutting rates and there's no inflationary pressure. Ideally, we want to get to a stage where every property you're buying is cash flow positive. I mean, that would be an amazing thing from a serviceability perspective and from a strategic perspective in terms of your property portfolio. This is also reflected in the ASX futures yield curve, which is a futures market predicting that there's going to be a 90% chance of a 25 basis point cuts in July and another 25 basis points cuts this year. So everything's on track, guys. The banks, the futures market, everyone is predicting that there's going to be 1.5% rate cuts between now and kind of mid next year, which is fantastic, because that means that interest rate payments for existing mortgages go down, people's serviceability goes up, people have more money to spend, and they start speculating and investing in property. The following chart shows the house prices generally record double-digit growth following a rate cut cycle. So what I think is going to happen is we had multiple increases. We had 13 increases in 14 months previously. And we went down from I should say, from 0.1% bank swap rate to 4.35, which is huge, right? Now we're going to see the reverse of that. Now, every time in the history of Australian property market since the 80s, which is kind of as far as you want to go back, because then the banking sector was regulated and controlled. The banking sector was deregulated in the late 80s. So you can see that in 88, property prices boomed for 2 years just after rate cutting cycles. And they went up in 88 by 60%. This is from median price, 92, 5%, 98, 15%. 2003, it was crazy. 2001, 2, and 3, property prices went up by 20, 30%, 32% combined for 2003. 2010, 15%. 2013, pardon me, 13%, 2017, 12%, and then 2021, 27%, which was the peak. Previously, Melbourne didn't do that well. Melbourne was stagnating since COVID-19, and it's about to recover, and it's about to start the growth super cycle. And the super cycle means that it's going to recover what it lost in the previous potential cycle that never happened. So it's gonna have double the growth virtually. The other issue is this: on the back of all this, as long as everything was going well, if the housing market was oversupplied with stock, we could reverse a lot of these conditions. But there is no chance, in my opinion, that the Labor government can do anything in terms of meeting the minimum requirement for the housing market demand right now. The Albanese government has no chance of meeting those commitments. Nobody believed the federal government target to build 1.2 million homes over 5 years was realistic. And they've built 0 homes, by the way, so far. The highest single year of construction in Australian history was 225,500 homes. In 2017, 6% below the annual target of 240,000 homes a year. That's the target there, the red line. You can see that's Albanese's housing target. And the blue line is the reality of what has happened. And majority of that, well, all of it is not government housing, by the way. It's the private sector building townhouses and housing apartments. So the Albanese government, because remember, the government isn't in the business of building houses. They need the private sector to create that stock. And all they need to do is to create an environment that is conducive to enabling private sector speculators, which are developers and builders, to build stock. And they haven't really done that. They haven't really even given them the minimum incentive to do that. So, and this is part of the problem with the Labor government. They don't know who their friend and foe is. And they keep punishing the wrong people and rewarding the wrong people with money and legislation. If they were smart, they would create tax incentives for the private sector around housing and development of new housing in key areas. And then therefore the private sector would find that attractive and build more houses. I mean, it's not rocket science. Or as Bush Jr. said, not rocket surgery. On the back of that also, which I keep talking about in my YouTube videos, because it is quite disturbing, there's the record numbers of construction firms that have collapsed, reducing the capacity to build across the country. You can see that the construction sector has been impacted more by COVID than the other sector. Second one is hospitality, and then professional services. I mean, hospitality, a lot of cafes, restaurants have gone bust. I know in Melbourne, in Lygon Street, in Fitzroy Street, cafes that have been around for 20 or 30 years have gone bankrupt for the first time, which is really sad. I pulled up in Fitzroy Street the other day and I parked my car and I was going to catch up for a friend to a coffee, and I gave him the address, but when we turned up, it was an empty building for lease. So there you go. So the construction sector has been decimated. 7,000 companies, which are building companies and developers, have gone bust since COVID-19 with no help from the government. And those people have left the industry. Many of them will never come back in. And that sector has been decimated. And this is one of the reasons why supply into the property industry is so low. And it's going to take decades to get us back to where we were pre-COVID-19 levels. So in terms of the housing shortage, you can see that for Victoria, in terms of gross new constructions, 306,000. The supply is 300,000. The implied share of the 1.2 houses we're supposed to build over 5 years is 306,000. So there's a massive, massive delay in producing that volume. And I don't think they're capable of even building that volume. We simply don't have the industry there anymore to sustain that. The NHSAC report warns that ongoing strong immigration, which is the other issue, is record high migration combined with poor supply, will continue to put pressure on renters and result in more homeless and overcrowding. Homelessness is a huge issue in Melbourne, Sydney, and Brisbane. We have record high numbers. And this is mainly on the back of net migration. And by the way, I'm a migrant from Poland, so I'm pro-migration. But I think we should definitely reduce the volume of numbers, and let's bring the housing industry to a level where it's matching people's expectations. But definitely, in terms of like any migrant that comes in, is taking the rental away from people that are already here, because we're competing for a finite amount of properties. Now, for investors, this is really good news, because if you're a landlord with properties in specific areas, you can actually start demanding huge rental increases in line with the market conditions, obviously, because of supply and demand. But if you're trying to get into the country and you're on a budget, which most migrants are, before they settle in and get a job and start getting kind of financial stability, it can be very challenging. And because of that competition, people are losing out and becoming displaced. And I'm not talking about people with, drug habits or people that have, different conditions. I'm talking about people that are legitimately working full time and they can't get it back into the rental market, which is very interesting. So in terms of that, the vacancy rates have been reduced to 0.1%, to 0.5, 0.6 in some of these suburbs that I'm sourcing. Overall in the market, you can see that normal rents should be, 4%, 3.5, and the normal vacancy rate should be 4.5. I mean, if vacancy rates of 1.5%, which you're seeing on this in this chart, is completely just off. It's unprecedented. I mean, there's virtually nothing on the rental market in that suburb. So good news for landlords, bad news for people trying to rent. And once again, there is no easing of migration. I mean, there's a small reduction now that's happened, but Labor is renowned for allowing more migrants coming into the country without planning resources and allocating housing for those migrants. Because I'm definitely against that strategy, but I'm pro-migration. I'm a migrant myself, obviously. So I'm for people coming into the country, but let's bring them in a way that is manageable. They get to buy properties. They get to have children in, childcare facilities and daycare centres, and they get jobs, and they're not sitting in traffic for an hour to the city each way, thinking about why they came to the country, which is what's happening right now in the western suburbs. The western suburbs in Melbourne have the highest growth by population, not the highest capital growth, but population growth. They are so inadequately supplied with the right infrastructure that people are paying the price. They're buying $750,000 metric on homes, 50 minutes from the city, and they're literally spending 2.5 hours in traffic every day just to get in and out of the city to work, which is unfortunate. Definitely auction clear rates have recovered now on the back of the interest rate cuts. You can see there for Melbourne, so we can see the red line. Definitely, that's the quarterly price growth versus auction clear rates, which is the blue line. And they're very much in sync with each other, because obviously the biggest sign of good, strong price growth is healthy auction clear rates above 75%, which is what we've been experiencing in the last few months in Melbourne, which is really interesting. Once again, I apologize for my voice. So that's going to continue on. I can see a very good trajectory with respect to where we're heading in the market. 75 to 80% auction clear rates is a very healthy auction clear rates. 8 out of 10 houses are selling, 7 to 8 out of 10, which is good. That's a very good, healthy market. It's actually a perfect market at the moment, and I think it's going to get better and better in Melbourne. Rental yields are high. People buying properties in areas that are blue chip with cash flow positive scenarios or neutral scenarios from day one. Limited stock is putting more pressure on rentals. That's not going to change anytime soon. We don't have the industry to fix that. And we might not have the industry for the next decade, I think 2 decades, to even catch up to where we need to be. Um, and, you're looking at a very healthy environment of legislation and regulations governing the housing market. There's been changes in landlords, legislation, and I think it's a good thing. I think people, overreacted. They thought it's going to be the end of landlords. I mean, land tax was very negative, but landlord changes just protects tenants more, gives them more rights with pets, with putting up paintings on walls, things like that. But it's nothing major. It just makes them gives them more respect, I guess, and in terms of the options, it makes them stay longer in properties. If anything, I can see it's a good thing. In terms of capital cities, one of the biggest determining factors of where we are in the property cycle is the growth of different sectors of the market. And so you can see that with Melbourne, you have the 25th percentile, the 50th percentile, and 75th percentile. And this is houses that are basically separated by price. So the 25th bottom percentile is the cheapest 25% of the market. So if you were to line up all the properties in Melbourne by price, the bottom 25%, and then you got the middle 50%, which is where the median price usually is. And then you've got the top 75%, which is all the mansions, in Toorak and Hawthorn and Brighton. Now, what's happened is that every time we start a property cycle, the top end, the 75th percentile, always takes off first, then the middle takes off, and then the bottom gets dragged up. This is excluding gentrification suburbs because they're very different. And I've done a YouTube video or two just on gentrification suburbs. But normal houses, normal suburbs, that's what usually happens. And what we're seeing now is the 75 percentile, which was very negative last quarter, is now 0.9%. And it's going up fast. So people now are buying those $3 to $7 million mansions in Brighton, Brighton East, Toorak, Hawthorn, Canterbury. And because they're buying them, more listings are coming on, and then people are getting the prices, they're upgrading, and it's dragging up the middle sector, which is the 50th percentile. And eventually the cheapest suburbs will go up in value, which is your Broadmeadows and, Frankston North and all those kind of areas, Glenroy, Hetfield. And once they come up, Footscray, which is very rough, once they come up, then those suburbs will do well and everyone will win. And that's the whole cycle. So and don't forget that. So the top suburbs right now in Melbourne in June 25, Balwyn North went up by 26.5. This is for annual change, but this is a 5-year change as well. And you got to look at properties long term. But Balwyn North, so these are the top prestige suburbs that are top performers in 25. Balwyn North, Surrey Hills, Eaglemont, Hampton, Blackrock, Hawthorn East, all doing 22 to 26%. Camberwell, Balwyn, Hawthorn, and then Malvern. That's a very good sign, guys, because that means they're starting to go up. They're going to drag up the middle sector, the $1 million sector, and then the bottom ones, like 500 to 700, will go up in value. And you can see that Melbourne has recovered. We've actually turned the corner. We've gone down. We're negative 1.2%. And now we're positive 0.4%, which is really good. So we've hit the bottom, and we've hit the bottom multiple times. And like I always mentioned, Melbourne and every other major capital city in Australia has a cyclical nature about it. There's up and down. There's an emotional high and reactive low. You just got to learn the cycles, understand where they are, and then make intelligent decisions based on your strategy. Some argue the bottom is the best time to buy. Some argue the peak is when you can make offers and revalue properties and get the equity out. Some like a market that is strong and stable. Every strategy is different. Personally, I love picking bargains at the bottom when auction clear rates are down to 40-50%, and probably get passed in, and then you make really good offers, and you can clean up. I've made a lot of equity doing that strategy by buying at the bottom, revaluating at the top. So I subscribe to the opposite of what everyone's doing, kind of a theory. So if everyone's going left, I go right, and I've done this all my life in certain scenarios. But especially in property, you buy at the bottom, you revalue the top, and you get the equity out and wait again for the bottom. Counter-cyclical investing, Warren Buffett. This is 101, guys. So my advice to you is we are at the bottom. We've just turned. The bottom was around April, May this year. June, July now, we've got a recovering market. Prices are moving already on townhouses. On stock that I'm selling in Heidelberg Heights and West, for example, townhouses, four bedders have gone up by 25,000 in 2 months. In terms of builder pricing, townhouses in Kilda are going up by 50 grand. Richmond by 200,000 from one project to another. So developers are increasing prices on the back of those escalating cost of construction and inflation. And then obviously that creates a new market every time they do that, because it's a new reference point for future pricing. So we've just turned the bottom. This is the time for you guys to get started, to do your tax returns, go to your mortgage broker or banker, get a pre-approval. This is the time to go in hard, because it's only going to get better and better in terms of interest rates and market timing. So my advice, guys, is don't wait to buy property or real estate. Buy real estate and wait, because the more you buy, the more compounding you're going to get, especially at the beginning of the next property cycle, which is where we are right now. And remember, even in 24, which was dead market in Australia, right? Like in Melbourne, I should say, was dead completely, right? Last year, it was negative, in fact, in median price. Princes Hill, 24.5%. North Warrandyte, 23.1%. Park Orchards, 20.2%. Dippendy, 20%. Brooklyn, 17.8%. Strathmore, 15.3%. Watsonia, 14.9%. Portsea, 14.5%. Diamond Creek, 14%. Launching Place, 13.2%. So just because the market's negative and going, sideways or in one direction, remember, as an investor, you can only pick specific suburbs and then invest in those suburbs. And that's what we do. That's what I do with Investors Prime Real Estate. I spend my day researching the market, talking to people that are much smarter than me and much more successful, especially a lot of valuers, accountants, financial planners, and investors, and working out what they know and how I can use that to my advantage and your advantage when I'm sourcing properties for my clients. So be fearful when others are greedy, be greedy when others are fearful. What's your next move, guys, for 25, 26? Many of you will do nothing. Oh, it's too hard, Conrad. I'm still dealing with stress from work and this, that, the other. And you know what? You're going to miss amazing opportunities if you do that. So don't stick your head in the sand, because this opportunity will pass you by. Properties are going to go up even more in Melbourne. If you're interested in learning more, get into the market. By the way, we are running live workshops again in Melbourne, in St Kilda. So we had a bit of a break for a while. Now we're back due to just people asking us to run workshops. So we're doing one. All you can do is scroll down below, check out the dates. It's a 2-day event with myself, Stephen McClatchy from Loans Australia, and Cameron Fisher from Changing Places Real Estate. And we're going to unpack this whole thing called property investing in a lot of detail and show you how you can pay off your mortgages in record time, and how to scale up your serviceability to unlimited level by buying properties through trusts, and how to do property due diligence and research in Melbourne, which are the best suburbs to invest in, which are the worst suburbs to invest in. If you're interested in attending, tickets are $47, VIP $197, and you get a hard copy of my book, Australian Real Estate Investing Made Simple, which is kind of like a manual for the 2-day event. They do sell out fast, so feel free, just scroll below and book your tickets now. For some of you might be also interested in working with me one-on-one, and spots are becoming extremely limited now. I'm running out of spots, and I will be stopping this in the future. I won't give people the opportunity, unfortunately, to work with me directly, because I just literally don't have the time. And I've got so many clients now that are existing, buying a 6th, 7th, 8th, 9th, 10th property. So I'm very loyal to my clients, but I will be hiring people in the future. I'm talking to a lot of skilled buyers advocates that will be jumping on board and looking after my future clients. So this could be some of the last opportunities to ever work with me one-on-one. If you ever wanted to work with me one-on-one, you don't need to work with me one-on-one. I'm fine with that. But if you do, this is your opportunity to have a free 1-hour chat about your situation. No strings attached, no fees. We'll just sit down, have a coffee in St Kilda, or we can do it on Zoom. Most of the time it's on Zoom now. No one wants to have coffees anymore. Well, no one can afford one anymore because they're like $6.50. But also the time constraint. Everyone's so used to Teams and Zoom now. So if you want to have a strategy session with myself, we'll sit down, work out where you are, where you want to be, and I'll give you some feedback, develop a plan, and you can walk away with knowledge exactly what you can do and you can't do. So many people just waste so much time and money doing the wrong things, targeting the wrong properties, and then 10 years later, they've spent everything they've earned and they haven't built any wealth. And remember, it's not how much you earn that determines your wealth, it's how much you keep. Imagine you did this 10 years ago and you bought 3 properties and they were all, 30 to 100% in equity today. What difference would that make in your life? So think about the last 10 years and then what are you going to do different next 10 years? You can always get more money, you can't get more time, and people just run out of time eventually. I see people at 65, 70 come to me, and we just honestly can't help them. Like, it gets to a point where it's not worth doing because you won't get the capital growth, and you're going to quit your job at 65. You won't be able to borrow money. It's going to be too hard to transition, from your working full time as an employee to a property investor. So the younger you start, the quicker you build up wealth because you need that compounding effect. You need those years of capital growth in the property market to wash over your property portfolio. That's why I say if you're going to buy 3 properties over 10 years, buy 3 in the first year and then wait for 9 years because of compounding. Don't buy one every 3 years, for example. So you get an hour strategy with myself. You walk away with a clear plan. I'll also give you access to the team. If you haven't got a good team around you, it's going to be virtually impossible to build wealth with property. You need a good accountant, a good mortgage broker or mortgage strategist, right down to lawyers, financial planners, quantity surveyors. I'll give you the whole list of people that I use myself. They are the best in Australia by far. I could use anyone I want personally. I don't get anything for them dealing with you. There's no kickbacks or anything, so I could refer any client to anyone in Australia. But these are the best to deal with, and at least you walk away with a team and a plan from that strategy session. And step by step, paint by numbers. Literally, you can't go wrong. So there is a qualifying criteria. You need to be able to borrow at least $700,000. I don't source anything under $700,000. So for a single person, you need to be on a kind of 95 grand a year, plus have about 120,000 in savings or equity. And for a couple, it's about 120, 140 per year combined income and about 112,000 or 126 in available equity that you can draw out against. If you do qualify and if you are interested in building wealth through property acquisition, passively, just accumulating really good growth properties with no headaches, either scan the QR code or just drop me an email, conrad@investorsprime.com.au, and we can organize a mutually convenient time to catch up. I hope you enjoy the video, guys. And I can tell you I'm very excited because the market is changing for the better. It was very dormant and docile for the last 4 or 5 years. COVID really took things to a new level in terms of we missed out on the whole growth cycle, and all the other major capital cities passed us by in terms of Melbourne. Now Melbourne's going to catch up and surpass all the capital cities except for Sydney. I think the median price in Melbourne will go from 1 million to 1.5 very quickly. So we're kind of facing that opportunity once in a 2-decade opportunity right now to get some really good properties and position yourself strategically to take advantage of these market conditions. That's it for me, guys. This is Conrad Bobilek. I wish you all the best in investing. I'll see you on the inside.